Life is full of uncertainties. We face risks every day, from driving our cars to simply walking down the street, yet sometimes the unexpected happens. When it does, the financial consequences can be devastating. This is where insurance comes in. It provides a safety net, protecting us from financial hardship. Imagine a fire damages your home, or you're in a car accident. Without insurance, you would be responsible for all the costs. Insurance helps you avoid these worst-case scenarios, providing financial protection and peace of mind. Before we dive into insurance, it's crucial to understand risk. Risk is an inherent part of life. It's the possibility of an unfavorable outcome.
Pure risk involves loss or no loss, but no gain. Examples include car accidents, house fires, or illnesses. These are typically covered by insurance. Speculative risk involves loss, no loss, or gain. Examples include investing in the stock market or starting a business.
Understanding these risks is essential for informed decisions. Insurance helps manage pure risks by transferring the financial burden. Pure risk represents the possibility of loss without the potential for gain. These risks are often unavoidable aspects of life.
Pure risks are the primary focus of insurance, offering a safety net. Insurance transfers the risk from an individual to an insurance company. This transfer of risk is the foundation of the insurance system.
Speculative risk, unlike pure risk, involves the potential for both gain and loss. Entrepreneurs who invest their capital in new ventures, for example, face speculative risk. The success of their business is uncertain. It could thrive and generate profits, or it could falter, resulting in financial losses. This element of uncertainty is inherent in speculative risks.
While speculative risks are not typically insurable in the traditional sense, understanding them is crucial for making sound financial decisions. Engaging in speculative activities requires careful consideration of the potential rewards and the possibility of losses. Investors and entrepreneurs often use various risk management techniques, such as diversification and hedging, to mitigate potential downsides.
Investing in the stock market exemplifies speculative risk. Stock prices fluctuate based on various market factors, and there is always the possibility of losing money. However, there is also the potential for significant returns. Investors must carefully assess their risk tolerance and investment goals before making investment decisions. Diversifying investments across different asset classes can help mitigate the impact of losses in any one area.
Speculative risks are an integral part of economic growth and innovation. Entrepreneurs and investors willing to take calculated risks drive progress and create new opportunities. While these risks cannot be eliminated entirely, understanding their nature and potential impact is essential for making informed decisions that balance risk and reward.
Subjective versus objective, two sides of the same coin. Subjective risk and objective risk represent two distinct perspectives on potential losses.
Subjective risk is personal, influenced by experiences and emotions. Imagine two people at a swimming pool, one confident, the other nervous. Their risk perceptions differ significantly.
Objective risk is based on measurable data and statistical analysis. It provides a quantifiable assessment of risk.
While objective risk offers insights, subjective risk influences individual decisions. People with high risk aversion might avoid activities or buy more insurance.
Understanding both risks is crucial for effective risk management. Section 1. Identifying and assessing risks. Managing risk effectively starts with identifying potential threats. This involves taking a close look at our lives, our assets, and our activities to pinpoint areas where things could go wrong.
Imagine creating a comprehensive inventory of your personal and financial landscape, noting everything from your home and belongings to your health and future income. Once identified, the next step is to assess the severity of each risk. Some risks might be minor inconveniences, while others could have catastrophic financial consequences. For example, a minor fender bender is a far cry from a major house fire in terms of financial impact.
Assessing the severity helps us prioritize which risks require the most attention and resources. Consider your health, a critical aspect of overall well-being. A sudden illness or accident could lead to significant medical expenses, lost income, and long-term care needs. Assessing the potential financial impact of these events highlights the importance of health insurance and disability coverage.
Identifying and assessing risks is an ongoing process, not a one-time event. As our lives evolve, so do the risks we face. Regularly reviewing and updating our risk assessments ensures that we stay ahead of potential threats and maintain adequate protection. This proactive approach to risk management is essential for safeguarding our financial well-being.
Section 2, Risk Management Techniques, a toolkit for protection. Develop strategies for managing identified risks. We have a toolkit of techniques to mitigate potential losses.
Risk avoidance involves steering clear of high-risk activities. For example, traveling by train instead of flying.
Risk reduction minimizes the likelihood or severity of a loss. Wearing seatbelts lessens injury severity in accidents.
Risk retention involves accepting financial consequences. For minor risks, we might forego insurance and pay for repairs ourselves.
Risk transfer shifts the financial burden to another party. Purchasing insurance transfers the risk of a house fire.
Section 3. Implementing your risk management strategy. Developing a comprehensive risk management plan is essential, but it's only effective if we put that plan into action. Implementing our chosen risk management techniques requires decisive action, from purchasing insurance policies to modifying our behaviors.
For risks we've chosen to avoid, implementation might involve making lifestyle changes, such as opting for less risky hobbies or avoiding certain geographical areas prone to natural disasters. These decisions, while sometimes challenging, align with our risk tolerance and prioritize our safety.
Implementing risk reduction strategies often involves investing in safety measures. This could mean installing security systems in our homes, attending defensive driving courses, or scheduling regular health checkups. These proactive steps demonstrate our commitment to minimizing potential losses.
For risks we retain, implementation might involve setting aside funds to cover potential losses. Creating an emergency fund, for example, provides a financial cushion to absorb unexpected expenses, such as car repairs or medical bills. This self-insurance approach allows us to manage certain risks without relying solely on insurance companies.
Transferring risks through insurance requires selecting appropriate policies and coverage levels. This involves researching different insurance providers, understanding policy terms and conditions, and comparing premiums and deductibles. Section 4. The power of regular review. Risk management is not a one-and-done endeavor. Just as our lives are constantly changing, so are the risks we face. Regular review of our risk management strategies ensures that they remain relevant and effective in the face of new challenges and opportunities.
Life events like marriage, having children, buying a home, or starting a business significantly impact our risk profiles. These milestones often necessitate adjustments to our insurance coverage, investment strategies, and overall risk management approach.
Periodic review also allows us to assess the effectiveness of our current risk management techniques. Are our insurance policies still adequate? Have our risk tolerances changed? Are there new risks we need to address? Asking these questions regularly ensures that our risk management strategies evolve alongside our lives.
The financial landscape is constantly shifting, with new risks emerging and existing risks evolving. Staying informed about these changes is crucial for effective risk management. Regularly reviewing financial news, consulting with financial advisors, and staying abreast of industry trends empowers us to adapt our strategies as needed.
Remember, risk management is an ongoing process, not a destination. By embracing the power of regular review, we demonstrate our commitment to protecting our financial well-being and navigating the uncertainties of life with confidence.
Section 1. Defining insurable risk. Not all risks are created equal. While countless risks surround us, only a specific subset qualifies as insurable risks. These are the risks that insurance companies are willing to cover, and they share certain characteristics that make them suitable for insurance. Understanding these characteristics is crucial for grasping the fundamental principles of insurance.
Insurable risk represents a loss event that meets specific criteria, making it appropriate for insurance coverage. These criteria ensure that the risk is measurable, predictable to a certain extent, and financially manageable for the insurance company. Insurance companies use these criteria to assess the viability of offering coverage and to determine appropriate premium rates.
Imagine a giant roulette wheel. Each slot represents a different type of risk. Only a few of these slots correspond to insurable risks. These are the risks that insurance companies have studied extensively, analyzing historical data to understand their probability and potential financial impact.
The ability to quantify and predict risk is paramount for insurance companies. They rely on actuarial science, a specialized field that uses mathematical and statistical methods to assess risk, to develop models that estimate the likelihood of insured events occurring. These models form the basis for determining premium rates and ensuring the financial stability of insurance companies.
Section 2. The hallmarks of insurable risks. For a risk to be considered insurable, it must exhibit specific characteristics.
These hallmarks ensure that the insurance mechanism functions effectively.
One primary requirement is a large number of homogeneous exposure units, like auto insurance relying on many drivers.
Insurable losses must be accidental and unintentional, covering unforeseen events.
This prevents moral hazard and maintains the system's integrity.
Losses must be measurable and determinable to ensure fairness in claims.
Finally, insurable risks must not pose a catastrophic risk for the insurer. Section 3. Examples of insurable and non-insurable risks. Insurable risks include fire damage and car accidents due to their accidental nature and accessible costs. Gambling and investments are speculative risks, not typically insurable.
Understanding these distinctions helps in managing financial risks effectively.
Section 1. Essential elements of insurance contracts. Insurance is a contract between the insured and the insurer. It must adhere to specific principles to be valid.
Mutual consent means both parties agree to the terms. Offer and acceptance solidify the contract.
The contract must serve a lawful purpose. It cannot cover illegal activities or profit from harm.
Principles of indemnity and insurable interest. Indemnity and insurable interest are fundamental to insurance.
They ensure insurance provides financial protection, not profit.
Indemnity means compensation matches actual financial loss.
It restores the insured to their pre-loss position.
For example, a totaled car is reimbursed at market value.
Insurable interest requires a financial stake in the insured item.
The insured must suffer a financial loss if the event occurs.
This prevents fraudulent claims and moral hazards.
Indemnity and insurable interest ensure insurance protects genuine financial interests. Section 3. Unique characteristics of insurance contracts. Insurance contracts possess unique characteristics that distinguish them from other agreements.
These reflect the nature of insurance as a risk management tool.
One defining feature is the principle of adhesion. Policies are standardized and offered on a take-it-or-leave-it basis.
The insured pays small premiums for coverage against large losses.
Insurance contracts are unilateral. Only the insurer makes a legally enforceable promise.
Finally, insurance contracts are conditional. The insurer's obligation depends on the insured meeting specific conditions.
Understanding these characteristics is crucial for making informed decisions about coverage. Section 1. Stock insurers, publicly traded protection. Stock insurers are publicly traded companies owned by shareholders.
They generate revenue through premiums and investment returns.
Profits are distributed to shareholders or reinvested.
This model incentivizes effective risk management.
Stock insurers can quickly raise capital by issuing new shares.
This provides financial flexibility for expansion and innovation.
Policyholders should review terms and conditions carefully.
Stock insurers offer a wide range of coverage options.
Section 2. Mutual company insurers, policyholders and the driver's seat.
Mutual company insurers are owned by their policyholders. This aligns the interests of the company with those of its policyholders.
Profits are returned to policyholders as dividends or premium reductions.
Policyholders have a voice in the company's operations. They elect a board of directors, ensuring decisions reflect their best interests.
This democratic structure promotes transparency and accountability.
Mutual insurers emphasize customer service and policyholder satisfaction. This focus can translate into personalized services and competitive premiums.
Section 3. Navigating the insurance landscape, agents and brokers.
In the complex world of insurance, navigating coverage options and policy terms can be daunting. This is where insurance agents and brokers play a crucial role, acting as intermediaries.
Understanding their distinct roles is essential for choosing the right professional.
Agents represent insurance companies, selling and servicing their policies. Brokers work independently, representing clients' interests and comparing policies.
Agents promote their company's products while brokers consider a wider range of options.
Choose based on your preferences and the complexity of your insurance needs.
The insurance industry operates within a framework of regulations designed to protect consumers and ensure fair competition.
These regulations, primarily enacted at the state level, maintain the integrity of the insurance marketplace.
State insurance commissioners oversee the industry, ensuring companies operate fairly.
The NAIC fosters consistency and cooperation among states.
Regulations protect consumers from unfair practices and ensure transparency. Underwriting involves evaluating applications to determine eligibility and set premium rates.
Insurance companies assess risks and classify them into risk pools.
This ensures premiums reflect risk and pools remain stable.
Underwriters act like detectives, piecing together risk profiles.
They examine factors like age, health history, and driving record.
These factors indicate the likelihood of future claims.
The goal is to balance risk assessment with competitive premiums. Rating agencies play a crucial role in assessing insurance companies' financial health.
Agencies like AM Best, Moody's, and Standard & Poor's analyze financial data to assign ratings.
Think of them as financial detectives scrutinizing balance sheets and investment portfolios.
They assess capital adequacy, liquidity, profitability, and reserve adequacy.
Their goal is to provide a clear assessment of an insurer's financial strength.
These ratings are valuable tools for consumers and businesses.
A high rating indicates financial soundness, providing policyholders with confidence. Understanding insurance is paramount to achieving financial security and peace of mind. We face risks daily, from the mundane to the life-altering. Insurance provides a safety net against financial hardship. It empowers us to face the future with confidence. By transferring the financial burden to insurance companies, we gain security. Insurance protects our homes, health, and income. This protection allows us to focus on what truly matters.